Investors are pulling money out of bond funds and finally putting it into stocks, and that's propelling the market higher. The fund flows are also filling up ETFs. But which ones? Joining me to talk about that is Dan Dolan. He's the Director of Wealth Management for Select Sector SPDRs. Dan, how much money are you seeing flow into your Select Sector SPDRs?
Well, in 2012, we had a pretty solid year. We were up $7 billion. Now, as the clock turned to 2013, it's accelerated. We're up $4 billion in the first 3 weeks of 2013.
And which individual SPDRs is it going into? Last year, financials did well, the XLF, healthcare did well. Where's it going now?
Well, to take a step back, the sector SPDR simply divide the S&P 500 into 9 pieces, and that $54 billion is pieces of the S&P 500. A real shift has occurred to early cycle, cyclical types of sectors. So in 2011, we were looking at utilities, healthcare, staples. 2012, it started getting a little bit more aggressive. And right now, you're looking at industrials, materials, technology, really early cycle stuff, people expecting the economy to rebound.
Well, I'm looking at tech right now, and your XLK, which is the Technology Select Sector SPDR, it's getting hit because Apple's getting hit.
Yeah.
Apple makes up around 16% of that one. Is that too heavy a weighting?
Well, it's a little bit less today than it was, a few weeks ago. But yes, I mean, it's the heaviest weighting in the index, but it's because it's by market capitalization. So if you look at IBM, Cisco, Intel, and all these underneath that, you still have a lot of broad diversification within the technology sector. So even a day like today, when Apple's down 50, 60 points, that's only down a little bit. So you get that broad diversification. It's all market cap based, Apple being obviously the largest cap stock in the US.
And traders have traditionally loved the Select Sector SPDRs. Is it catching on with retail investors now?
We're seeing many, there's a trend where people are trying to minimize single stock risk. So can I buy something that looks and trades like a stock, but have a basket of securities so I minimize that single stock exposure? We saw it first on the institutional side where that trading occurred. So when the markets are really volatile, we'll trade 200-300 million shares a day. In 2012, we traded about 140 million shares of sector SPDRs per day, driven by the institutions. Now more and more retail investors are saying, I don't need that single stock risk. If I'm right about the price of oil, I think it's going higher, let me buy a basket of energy companies. If I'm right about interest rates and we think we're going to stay where they are, financials are going to recover, let me buy XLF. I don't have to pick Citigroup or Bank of America. So minimizing risk is a big part of this whole play.
Now, this week we're celebrating the 20th anniversary of the SPDR, the SPY. Your Select Sector SPDRs have been around almost as long. What do you think of all the other ETFs which have come up along the way? Where do you think they'll be in 20 years?
Well, I think we're going to get bigger. But I think what's happening now is you've gone 20 years ago with the SPY launch, you now have 1,500 ETFs. Will that continue? No. I think what will happen is that the big boys will get bigger. And some of the guys that have struggled for assets will probably continue to struggle. You'll start to see additional innovation on the managed or non-index based ETF. But I think that the core of it, the core qualities of an ETF, transparency, low cost, liquidity, that's going to drive the day. We'll continue to see the big boys gather assets.
Thanks a lot.
My pleasure.
Thank you for watching The Street.